Okay, what was Bank of America thinking? Your guess is as good as mine. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Bubble Turns, Market Churns, Things Crash and Burn, who knows, right? Today is September the 6th. Hope you guys had a great Labor Day. Randy Patrick here, putting the realism back into real estate. Again, hope everyone's doing well. We're off to the races in the month of September. This video, of course, is brought to you by who? Our friends at Foreclosure.com. So if you want to check out the distressed properties in your neighborhood, go to GetHousingData.com. That's GetHousingData.com. Gives you a quick and very accurate and good snapshot of what's happening in your neighborhood so you can see what type of properties you may want to pursue or go after for purchase or investment opportunities. So again, gethousingdata.com. That is my affiliate link. All right, guys. So interesting enough, this happened last week, but I figured I'd give it a couple days before I chimed in on it. So 2008 all over again, B of A, so Bank of America, just launched a test of zero down payment, zero closing cost mortgages for minority communities. All right, so when you first see this, and again, I want to be clear here, I'm not going down a specific path with this. I'm basically saying the timing of this is what concerns me. If they wanted to launch something like this, they should have launched this 2, 3, 4 years ago, not where we are today. That, I think, is the real issue. Because again, now there's even more comparisons to what's happening now with respect to the 2008 bubble. So that's kind of my first take on this. So we'll go through it and sort of unpack this right now. So basically, in a move that has sparked outrage over discriminatory preferential treatment, Bank of America will be offering zero down payment mortgages with no closing costs or minimum credit scores to first-time home buyers in Black and Hispanic neighborhoods in Dallas, Detroit, Los Angeles, Miami, and Charlotte, North Carolina. So, okay, it's a test market. We've got, 2, 4, 5 locations going on here. Are these locations that maybe have higher than average home prices? Maybe all of them except Detroit, as far as I know. But the whole point is they're doing a test market here. And again, I get where they're coming from. Let's help the communities that need more help and assistance to increase home ownership in those communities. I get that. I'm 100%, backing those type of, opportunities. That's great. The issue, though, is how it plays out and the timing of it, as I mentioned. So applicants won't have to disclose the race. Reason being, because you're buying in the predominantly, those communities, as they mentioned, they'll determine which neighborhoods are predominantly Black or Hispanic. So the program will have no minimum or maximum loan size for the new offering, which qualifies as an FDIC special purpose credit program. So no minimum is fine, but no maximum. This is where, things can get out of hand. Usually there needs to be some sort of caps on stuff. Even FHA does have loan limits on their loan programs. This is no minimum loan size, okay? Those who apply for the loans will be considered on a non-traditional factors, such as reliable payment of rent, utilities, cell phones, and auto insurance, the company said. Basically, the program will ditch credit scores so that people can use other mechanisms to define credit worthiness. Buy a home and build wealth. So again, we all get what they're trying to do here. Let's just see if it still makes sense. So the pilot program is called the Community Affordable Loan Solution, right? Obviously wants to make home ownership more sustainable for people in those communities. That's great. But what happens when all these houses are underwater amid a deteriorating economic backdrop or even higher interest rates? So of course, B of A is saying, hey, we're already anticipating some slide here. B of A is giving borrowers $10,000 to $15,000 so they have immediate equity in their home. So what they're really doing, saying we're going to give you zero money down mortgage, and essentially we're going to give you a grant, probably a grant that you don't have to pay back of $10,000 to $15,000 to give you a little bit of buffer with respect to what is, again, establishing some equity here. So while no down payment mortgages potentially make it easier for lower income borrowers to buy homes, they're not without risks, of course. If the housing market were to slump, homeowners without significant amount of equity may have little incentive to keep paying their mortgages, thus hurting their credit scores and sticking lenders with foreclosed homes. That's why B of A is giving the down payment grants of $10,000 to $15,000. So there's immediate equity. Well, so this is where we're going to check this out towards the end. But that seems like, it's a lot of money. But in the end, 10 to 15K is not huge. Okay, they're going to B of A is going to absorb closing costs and things like that. You're going to get some grants, so it's going to be zero money down. But in the end, when you take a look at your equity, this is where it's kind of precarious, right? Obviously, they're going to qualify applicants with the ability to repay. Well, which is kind of weird because they're not really looking at credit scores, but they still want to take a look at the ability to repay. So it's a little bit of how can I put a little bit confusing here. Like, so what are they going, to do? I mean, if you have the ability to repay, shouldn't your credit scores be decent? I don't know. So is this another version of subprime? Who knows here, but it's very interesting how this kind of plays out. So having said that, if you guys appreciate the information I put out here on the YouTube channel, if you do me the great honor and subscribe to my channel, I'd really appreciate that. And by the way, if you think you're a subscriber or you're a subscriber, could you please hit the subscribe button and verify? Because a lot of weird and wonderful things happen here on the channel. So again, appreciate everyone's patronage and the views, of course. So interesting enough here, critics of the program are quick to point out that it could backfire and potentially harm the communities it's designed to help, which I actually tend to agree with here. So obviously we've seen back in the 2008, housing crisis and crash, we saw what sort of predatory lending did to, didn't happen, yes, to specific communities across the country for sure, and just people who really shouldn't have qualified. I mean, loans were made available, and a lot of those people didn't understand the loans. They really weren't explained the loan programs. The loan originators got you into the program right then and there because it made sense. They didn't talk about or explain what happened when adjustable rates came in or different changes, et cetera, et cetera. So net result, a lot of people were hurt by this, lost their homes, paid the price. All right. It's likely that at least some of the borrowers under the Bank of America's new program would be considered subprime by ordinary lending rules. Basically, credit scores between 580 and 669 are subprime. While credit scores aren't always an accurate barometer of the buyer's purchase power ability to make timely payments, advocates worry the interest rates required to make up for the low bar the lender is setting could set minority buyers up for failure. So that's a pretty important point here. So again, you're going to communities who, and trying to help them or incent them to get into the housing game, targeting first-time home buyers who might be a normal credit stretch to begin with, but yeah, you're making some exceptions here, which are great. For me, the issue is the timing, okay? We've sort of already peaked on the housing bubble. We're starting to see the slide right now, and mortgage rates are high and will continue to rise. So for the next little while. So that really, to me, does not sound like a good recipe for success. It's more like a recipe for disaster. Again, if you slide, if property values are sliding. It's not if, it's really when and by how much. Okay, so property values are sliding right now. So you get into a loan now, you pay a pretty penny for it. The no minimums, whatever. So hey, it's great. I can go out on my shopping, home spending spree. I'm going to get taken care of here. As long as I can qualify by my income, I'm doing well. And then guess what? There's a change in the marketplace. I'm not doing so well. So really, to me, it's not. I just don't think the timing's good. But this is what always happens. All right. So what do lenders do? Lenders loan. That's their business. They don't loan money. They don't make money. That's the way the world kind of works here. So it's kind of like, well, how can we get people into the real estate market? How can we get them to take our loan products? So obviously, by removing virtually all barriers to entry, we can get more people in. But again, as they said that here, what they're doing is making it very easy. But there's a couple of things. Number one, when you don't have skin in the game, you don't take it as seriously. Okay, so you might as well be renting. To me, if something happens, well, I didn't have to pay anything for it anyway, so I'm not losing any of my equity, so I don't have to do whatever I need to do to save this or stop this or whatever. That's always a sentiment that comes in with these low down payment loans. I can tell even back a few years ago, before the pandemic set in, there were loan programs going out there to conquer the student loan issue. A lot of people, I guess you could say a lot of the millennial groups, or at least a millennial generation, a few years ago was saying that student loan debt was one of the biggest barriers that they needed to overcome to purchase a home. So what did some mortgage companies do? They actually provided 100% mortgage coverage, and what they were doing is they were rolling the unpaid student loan into the mortgage. So they'd pay off your student loan up to 120%. So you bought your home for 100% of value, they pay that, and they give you another 20% more loan to value mortgage to take care of the student loan. So again, it's fixing problems or trying to fix problems that maybe aren't true problems, or they're trying to again, creativity is great and solutions are great, but sometimes you can see how some of these programs are set up for success. I mean, the people that took that 120% deal, in other words, if you didn't have appreciation, you were immediately 20% underwater. So how are you, if you had to sell, what were you going to do? So you had to hope like heck that your home would appreciate at least 20% over the next couple of years. Now, that may have worked in some locations for that, but again, same thing here. Will homes appreciate? Well, I don't think they're going to appreciate. As a matter of fact, we've got tons of economists and analysts saying that there's the slide's happening, and we're looking at 10, 15%, nationally across the board minimum, and various metros, being even more of a swing. So some of the, we have the Charlotte, the Dallas, the Detroit, Miami. I forget in LA. Yeah, I mean, I think losing 10 to 15 to 20% in all those locations is a very real thing, and it's a possibility. So that's how homeowners are going to get stuck, because again, what do you need to do? When you have to sell a property on the, with MLS, with real estate agents, whatever, closing costs, commissions. Closing costs will always be in there. Depends on who pays for them, but commissions 5-6%, so you're immediately underwater. That's the point to all this here, guys. So anyway, that's kind of my take on it. I don't think it's that great a program. This is a tweet that was that came out that was along with the article here. It says obviously 100% loan to value mortgages while interest rates are at decade highs and values falling quickly. They'll be trapped underwater and unable to refinance when rates decline. Predatory lending at its finest. It's exactly what this really is. So again, trying to help communities that need the help. I think this is done at the wrong time. Sure, do this 2-3 years ago when this type of loan could benefit from appreciation. This is the problem. You get into a loan like this right now, there'll be no appreciation. We're seeing depreciation. We know values are going to slide, so they're going to be immediately underwater. And as they're suggesting here that, we don't know what the interest rate's going to be, right? They haven't said anything of interest rates. They're saying we're no closing costs. We're going to give you grants. So as the sort of, the one article sort of suggested, to get that, they got to make it up someplace else. So we're going to see a higher than average interest rate. So the chance of refinancing, like at high interest rates where it is now, it will be difficult. So I just think this is kind of little too late for what's going on out there. And let's take an example here. So Miami was one of the locations, right? So I just did some real simple math here, right? This is the most recent information from Florida Realtors. Okay, this is the Miami sales. Now the Miami metro is a bit expansive. Okay, it's Palm Beach County, Broward County, Miami-Dade. Okay, so the retail sales for a single family home, the median sales price was $595,000. You can see that up on the chart right there. Okay, well, if we say you wanted to buy a home under this program and the median price is $595,000, well, guess what? If you were going to get a grant of $15,000, essentially that $15,000 amounts to about a 2.5% spread or sort of down payment. So you're not quite paying FHA rates. You're actually paying a little less than that, as far as down payment's concerned. But that's your spread there. So if we do the math, okay, just if properties just remained at that value and didn't change over time, if you had to sell, let's say you hired a real estate firm to sell your home, okay, 5% commission, you're already underwater. 2 or 3 points in normal closing transaction costs, okay, you're farther underwater. Are you going to bring money to the table to pay off your loan at closing? No, because you had no money down to begin with, you see? So and no skin in the game. So this is where things can go wrong and people can get caught. And as I said, I understand the reasoning behind it, which is, let's face it, is it good reason? Sure it is. Is it designed for success? I don't think so. Could these borrowers be more precarious to fall into financial issues and or get caught by, I guess you could say, loan to value changes going down, things like that? Probably, and this would be a higher loan, more of a subprime, riskier loan. So in the end, as few of the critics are saying, is this really a good program for these communities? Personally, I don't think so. And as I said, should have been launched a couple years ago when, hey, it helps to compete in, by getting homes that were appreciating. There was some buffer there for a period of time. So again, doing this once the peak of the market's already, crested, where we start seeing some slides, is like a last-ditch effort for Bank of America. That's my take on it. I mean, it is what it is. I just want to start the week off with a little, information about this. Just goes to show what's happening. And for me, when I think housing bubble and housing crash, when I see stuff like this going on, that's one more indication of where we're headed, right? Because lenders are going to get more desperate. We hear that, obviously purchase applications down, refi applications down. Every day in the news, there's mortgage companies or laying off staff or closing their doors or actually shutting down, believe it or not. Some lenders are. So that is a telltale sign that things are not right in the marketplace or things are changing. And, as I said, it's like last ditch effort by B of A to say, hey, let's pull a save here. Let's see what we can do. Is it a little bit of virtue signaling? Maybe. Is it, philanthropic, whatever the word is? Maybe, or to that extent, right? Helping communities that need it. I get it, and that's fine. But does it really? And when you look at things in the end, does it really help someone? Okay, and what you don't want is someone to go in and have 6 months or a year of home ownership to lose their home pretty quickly afterwards. That would be a shame, and that would not be that wouldn't really support the program in its entirety here. So that's my thoughts. Okay, guys. Again, you want to talk about pre-foreclosures? This is a little snapshot of Denver, Colorado, sitting with 706 pre-foreclosures right now. So for those people who think we don't have any problems in the marketplace, Denver is a high-value, highly appreciating market, and yet there's 706 pre-foreclosures sitting around here. What does that tell you? It tells us a lot of different things, and then maybe all the housing narrative is not correct. Okay. So anyway, as I always mention, I'm looking for agents in Florida to join my firm. Particularly, I'm actually looking for what I would call specifically a BPO agent, a broker price opinion experienced agent that has some of that business going on. I'm looking for that. I'd like to open up other metros across the country. Need more investor buyers. Looking for private lending partners who want their money to do work for them. Looking to start syndication equity funds. We're involved now in tokenization of real estate and selling in real estate via NFTs, crypto, et cetera, et cetera. We're involved in stuff like that. Really cool stuff for the future. So please reach out to me. As I mentioned, I'm launching my Foreclosure Fortune product right now. So get in early. I can tell you all about it. I'll be doing a lot more work on it as the month goes on in formal launch. But get in at the better prices because things are going up big time for a number of reasons. So please reach out to me, jump into the game. Connect with me, Randy at luxuryshortsales.com. And once again, I appreciate the views, likes, comments. Please share the video with your family and friends. Subscribe if you're not a subscriber, and look forward to speaking with you later in the week.